Okay, you don't want to miss this episode. We're going to talk about the small business rate in Canada, how much tax do business owners pay, what happens when you go over the $500,000 limit. Let's dig into it. Hi, everyone. I'm Darren Mitchell. Welcome to Control and Compound. Joining me as always, Christina Wyatt. Christina, how you doing today?
Hey, Darren, I am doing great today. I'm excited for this podcast episode. I know it sounds simple enough, but a lot of business owners don't really dig into it. So I'm excited to kind of dig into the numbers and do the math on it so you can see exactly, where their tax rate lies.
Yeah, and I mean, let's face it, a lot of business owners just give their stuff to their accountant and say, do my stuff, and they come back and say, here's how much tax you own. Don't get into a lot of strategy sometimes. But I thought this was, we're going to try to simplify it and just say, okay, this is exactly how it works at this level and this level. And we're going to talk about each provinces because every province is different in Canada because we always have a federal portion of the tax and a provincial portion of the tax. But I'm looking forward to this.
Yeah, and we love doing these podcasts for business owners. So if you're a business owner out there listening, you're definitely going to want to subscribe. If you're listening on your favorite podcast platform, subscribe and leave that 5-star review. If you're listening or watching on YouTube, make sure you like, subscribe, hit the bell button so you always know when new content is coming out, because as a business owner, you're not going to want to miss this stuff. So subscribe, please.
All right. So where to start?
All right, so I think we should always start with the basics. Who qualifies for the small business tax deduction, and what are the current rates right now in Canada? Because you said it differs by province. Let's kind of dig into who qualifies and what those rates are currently.
Yeah. So I'll talk big picture first. So big picture, the first $500,000 a small business earns is taxed at a lower rate. Once you exceed $500,000, the amount over $500,000 is taxed at a higher rate. They don't take away the lower rate you had on the first $500,000. But to be really clear, you have to be considered a Canadian-controlled private corporation in order for this to be eligible. We get a lot of real estate investors going, "Oh, I just have a real estate holding company. Do I qualify?" And the answer is no. So some of the qualifications are it has to be active business income. So it can't be passive, right? You think of a holding company sometimes as considered a passive investment. You take money from your opco, you slide it into your holdco, and then you buy stocks, cash value life insurance, real estate. That's considered passive income. So that corporation's not going to qualify. But if you have an active business, right, you're an incorporated company, the first $500,000 is going to be taxed federally at 9%. So the first $500,000, feds are going to get 9%. And then the provincial rate ranges from anywhere from 0 in Manitoba and Yukon up to 3.2% in Ontario and Quebec. So if you're in Alberta and you earn $400,000, we're going to take the 9% federal, 2% provincial, adds up to 11. You're going to be in 11% tax bracket. So on $400,000, you'd pay $44,000 of tax as a business. Now, if we kind of quickly go through and say, okay, do the math for me, take provincial, take the federal, slap them together. What's the rate in my province? Well, Ontario's 12.2, BC and Alberta are 11, Manitoba's at 9, New Brunswick's 11.5, PEI's at 10, Nova Scotia's at 11.5, Newfoundland's 11.5, Nunavut's at 12, NWT at 11, and the Yukon at 9. So just a point here, I talk about the first 500,000. There have been a couple provinces increase that. So we've got the Saskatchewan and Alberta have a $600,000 small business limit. But a key note here, the federal government doesn't care what the provinces do. So the federal government rate is still going to go up after 500,000. But if you're in one of those two provinces with the $600,000 limit, your provincial rate doesn't go up to the higher rate over 500,000 until you hit $600,000.
Yeah, and here in Nova Scotia, we actually got some good news with our premier that was just reelected. He ran on the promise that he is going to be increasing our small business limit to 700,000. So can you imagine we're going to be higher than Alberta? That's I've never seen it. So this is exciting for us. We've always been the highest tax paying province. So I'm excited for that.
So let's just kind of recap the example of the small business up to 500, then we can get into the larger one. So roughly speaking, if you're a Canadian business owner, your business on the first 500,000 is going to pay somewhere between 10 and 12%. Okay, so somewhere between 50 and 60,000 on the first $500,000 of income. Now remember, this isn't your salary. You've already paid your salary to yourself. If you take a salary, you've already paid the employees. You've paid this is your net profit after you've paid everything out. On 500,000, you'd pay between $50,000 and $60,000 of tax as a Canadian business.
So you've got more buying power inside of your corporation, right? You keep it inside the corp, you're only paying that small business tax versus taking it out. So that's why we see a lot of business owners keep their money inside their retained earnings inside their corporations. Now, we typically don't see them just keep them inside their operating company, though. For a number of reasons, what you're going to see happen is they will shift their funds to a holding corporation. So they'll do an intercorporate loan, intercorporate dividends, but they will move those funds, the retained earnings, now tax-free, like they can move them from one corporation to the other. And that's where you're going to see business owners do their investing. So like you said, in stocks, have your high cash value life insurance, your real estate, you're going to invest in a holdco for a number of reasons. One being just liabilities. You don't want that those investments mixed in with your operating company, especially if your operating company can become liable for something. You want to keep those separate. As well, down the line, you want to be able to get that lifetime capital gains exemption. You can't have a lot of cash and investment sitting in your operating company to do that. So a lot of the time we will see business owners shift from their operating company to their holdco, but these dollars are still remaining the same. They're not changing. So when we're talking about dollars, opco, holdco, same tax rate for those dollars in the operating company moved up to the holding company.
Yeah, and you can always loan the money back from the holdco to the opco if the opco needs it. So
yeah. Oh, yeah. You set it up and do set it up with a professional. We're not accountants and lawyers and whatnot, but work with a corporate structuring lawyer, an accountant that knows what they're doing, and they can absolutely make sure that you can efficiently move those funds back and forth between the two without causing any tax issues. Now, we talked about that first 500,000, but there's a lot of business owners or businesses out there that are going to make more than 500,000, which is amazing. But what does that look like from a tax side of things? Let's dig into that a bit.
Yeah, I mean, just to note on that too. You remember, you could have 2, 3, 4, 5 shareholders in that company too, right? So a $500,000 income for 4 or 5 shareholders doesn't seem like a lot of money, but obviously, a lot of businesses with one shareholder make over 500,000. But one of my bones of contention. So that $500,000 limit for the first 500 at the smaller rate. That started January 1st, 2009, being 500,000. Now we're in 2025 and the limit is 500,000. So over that time period, it didn't increase at all. Over that same time period, the average house in Canada back in January 1st, 2009 was around 300,000, and today it's over 700,000. So things got a lot more expensive. Everything else went up, but that small business limit did not go up. So again, I think that's terrible for trying to get people to start businesses. When you start making it more and more difficult and pay more and more tax, it doesn't encourage a lot of business owners. But okay, enough about the rant. Now let's talk what happens over $500,000. And this will probably come to no shock to you, Christina. But once you exceed $500,000, yes, your taxes go up, but they make it more confusing. So the tax rate, I'm gonna make it simple at the end for you. But the tax rate over $500,000 is 38%. But they have this offsetting 10% federal income tax abatement, and they have an additional 10% general reduction, which brings it to 15. So if you want to just forget about the 38, forget all about that. The federal rate, once you go over 500,000, okay, even if your province says we're going to increase the small business to 600,000 or 700,000, the federal rate, anything over 500,000, is going to jump from that 9 up to 15%. And then if we add provincial tax on that, that's going to vary anywhere from 8% in Alberta to 14% in Nova Scotia, New Brunswick, 15% in Newfoundland. Ontario comes in at 11.5%. So if we do the same thing we did, so this is just for incomes over 500,000, you're going to have Ontario at 26.5, BC at 27, Alberta 23, Manitoba 27, New Brunswick 29, PEI 31, Nova Scotia's 29, Newfoundland's 30%, they're the high ones. Nunavut 27, NWT 26.5, and the Yukon at 27. So that, again, the first 500,000, you're going to pay that 10 or 12%. Over that, you're going to pay that 25 to 30%, depending upon your province.
Great breakdown. Can we put some math behind it though, just to bring a clearer picture of the numbers? Let's just use some actual math.
Okay. So depending upon the province, 10 to 12% in the first 500, anywhere from 23 to 30 or 31 over that. So let's take Ontario as an example, 800,000. If you're an Ontario business and you make 800,000, your first 500's at 12.2, your next 300 between 500 and 800 is at 26.5. So that equals 140,500. So in Ontario, on an $800,000 income, a business would pay 140,500. If they were in Nova Scotia, it'd be 144,500. And if they were in the Wild Rose province of Alberta, 124,000. So pretty significant difference when you get into those larger amounts in Alberta, 124,000 versus, what do we say in Ontario, 145. So
yeah, and I know we're going to have some listeners out there that are not business owners, and they're going to say, "My gosh, they made 800,000. They only have to pay 140,000. That's crazy. Corporate business owners don't pay enough tax." But I can assure you that that is not where the taxes end for us, right? That's not where taxes end. Let's dig into this a bit more, because let's just take that out of the equation right away. They're definitely going to pay more tax.
yeah. So yeah, great point, Christina, because I mean, the technical term for the amount of additional tax you need to pay on top of that corporate tax is a boatload. So it's a boatload of additional tax. So you're going to pay tax if you want to get that money out of your corporation to yourself personally. You're going to pay, you have to dividend it out, you're going to pay tax. You're going to pay tax if you invest that money where there's growth on that, could be tax upwards of 50%. If you die, they're going to tax you like crazy when you die on that money inside the corporation. Now we have this passive income grind in Canada that if you make more than 50,000 of passive income, even say in your holdco, well, that $500,000 small business tax rate, the lower rate, that could be gone depending if you make over 150,000 of passive income. So that's going to be there. And then this capital gains inclusion. Remember, for individuals, it's still at 50% inclusion rate up to 250,000. Business owners, business owners, $1, they're going to have a 67% inclusion. So there's more than I'm talking about, but that's 5 additional layers of taxation. So trust me, business owners are paying all kinds of tax, Christina.
Yeah, absolutely. The tax doesn't stop there. It just starts there when we're talking about the small business tax deduction.
Now, there is one way that business owners can, if you're a corporate business owner and you have this retained earnings inside your corporation, you can actually avoid all those levels of taxation. And Christina, as our resident corporate expert, why don't you share with us how you can avoid paying additional tax after you've paid your income tax inside the business?
Yeah, absolutely. So if any of our listeners know, high cash value life insurance. So corporate owned high cash value life insurance is going to be your ticket to reduce or eliminate some of these taxes. So what happens is you save your retained earnings inside of the corporation, but most people will take it and they will want to invest. Why not? You can't have inflation eating away at it. They'll take it to invest, and you're going to get hit with all those layers of tax that you just talked about. Well, when we save in our high cash value life insurance policies, we don't have that. So the first layer of tax that we can eliminate is tax on growth. You talked about capital gains at 67%. You do an interest or a GIC, that's like 53%. It's the highest tax rate possible on investing in your corporation. We do not have that with the high cash value life insurance, right? It's like a tax-free savings account inside your corporation. All that growth is tax-free. Also does not create passive income, that issue that you talked about with the passive income grind. We do not have that problem with our life insurance policies. Doesn't create passive income, does not impact that small business tax deduction. You're going to keep it whole. The next thing that we can eliminate is tax on death. So if you've got cash sitting in your corporation and you pass away, or investments, your family can't just pull that money out tax-free. They've got to pay the dividend to get it out. Well, what happens with the life insurance when the death benefit pays is it pays to the corporation tax-free, credits the capital dividend account. This is a big one, the CDA. That allows the new shareholders or the existing shareholders of that corporation, it's your family, to pull that life insurance death benefit from the corporation tax-free as a capital dividend. That is crazy. Like, we don't have that anywhere else. This is the only place that you can get a tax-free influx of cash like that. So estate planning for corporate business owners, huge. But then as well, once we hit retirement, so what happens with a lot of business owners is they're like, okay, well, these are 88-cent dollars. I'm going to save in my corporation for retirement. They hit retirement, and now it's like, okay, it's time to start taking out for my lifestyle. I got to pay that dividend or that salary, right? It's not going away. We have strategies that we can use with these high cash value policies to be able to set up collateral lines of credit and pull out that money tax-free as well. So we can actually eliminate 3 layers of tax and some of those other issues that you talked about by using those corporate life insurance policies. So an amazing strategy that any corporate business owner needs to learn about if they haven't yet.
Wow. So eliminate 4 or 5 levels of taxation and be able to access that money tax-free personally in retirement. So you save for your corporation in the early years, and then the bonus is you get to use it personally in the later years. Amazing strategy. That's an overview of taxes. If you want to learn more about this corporate-owned life insurance, please reach out to us, Control and Compound. We are experts at this, and we deal with it with business owners across Canada. Anything else, Christina?
No, I think we covered it for today.
All right, that's it. Thanks for watching. Thanks for listening. Have an amazing day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.